Stop scrolling right now because what I am about to reveal will shock you. Gold just crossed $2,750 per ounce this week. This marks a 30% gain in just 12 months since January 2025. Bitcoin is sitting at $90,000 after Trump's crypto policies created massive volatility. Central banks bought over 1,000 tons of gold in 2025 alone worldwide. Goldman Sachs just upgraded their forecast to $3,500 by 2027. Some analysts are predicting gold could hit $4,000 within 18 months. The global financial system is going through the biggest transformation in 80 years. In the next 20 minutes, you will discover what is really happening today. I will show you why central banks are panicking and stockpiling gold. You will learn exactly what to do before your purchasing power gets destroyed. Everything you thought you knew about money is about to change forever. Stay until minute 18 because that information will transform your financial future completely. This is not speculation. This is what is happening right now today. Your wealth depends on understanding what comes next in the global economy. I am not a financial advisor, and this content is educational only. Nothing in this video constitutes financial advice, investment advice, or trading recommendations. You should not make investment decisions based solely on this video content alone. Always do your own thorough research and consult licensed financial professionals before investing. Markets are volatile, and you can lose money in any investment rapidly. Past performance never guarantees future results in any asset class whatsoever. I may have personal biases and positions in assets discussed in video. Now let's dive into what is really happening in global markets today. Let me hit you with the facts that mainstream media is ignoring completely. These are the most critical financial developments happening right now in January 2026. Your financial future depends on understanding these game-changing events unfolding before us. January 19th, 2026 marks another historic milestone for precious metals. Gold crossed $2,750 per ounce this week. This represents a stunning 30% gain over the past 12 months. The momentum is accelerating and showing no signs of slowing down anytime soon. But here is what television news is not telling you at all. This is not just about gold prices rising in dollar terms temporarily. This represents a fundamental shift in how the world views money itself. The entire global monetary system is restructuring right before our eyes in real time. Central banks added 1,037 tons of gold in 2024 officially. Early data suggests 2025 saw similar or higher purchases by governments worldwide. This marks the third consecutive year, above 1,000 tons in purchases. No other asset class has seen this level of institutional accumulation consistently. 3 straight years of record buying is unprecedented in modern financial history today. Central banks are telling you something critical through their actions, not words. They are preparing for something big that most people are not seeing yet. Who exactly is buying all this physical gold right now across globe? China's People's Bank added gold for 18 straight months through November 2025. Their official holdings now exceed 2,400 tons of gold. But analysts believe China's real holdings are much higher than publicly reported numbers. India's Reserve Bank holds over 840 tons and keeps buying. Poland shocked the world by becoming Europe's largest buyer in recent years. They added massive amounts, bringing their reserves to over 300 tons. Turkey continues aggressive buying despite economic challenges at home facing their currency. Kazakhstan, Czech Republic, and Singapore are also accumulating gold reserves significantly and quietly. The list of countries stockpiling gold keeps growing longer every single month. These are not random decisions made by bureaucrats without strategy or planning. This is deliberate strategic positioning by nations preparing for currency system changes ahead. The US dollar index has been showing weakness despite temporary rallies recently. Global debt has now surpassed $320 trillion worldwide. Every major economy is drowning in debt that can never be repaid. Everyone from central bankers to billionaire investors is asking one critical question now. What happens when the dollar finally loses its status as reserve currency? Gold already knows the answer and has been screaming it for years. Smart money is listening while the masses remain completely asleep to reality. This analysis is based on publicly available data and news reports only. I'm presenting factual information about observable market movements, not predictions here. Your investment decisions must be based on your personal financial situation entirely. Always consult qualified professionals before making any financial moves in volatile markets. Past performance does not guarantee future results in any investment category ever. Markets can behave irrationally for extended periods, defying all logic and analysis. Economic data can be revised and may contain errors or inconsistencies. You might be thinking that gold is just a barbarous relic now. We have cryptocurrencies, we have stocks, we have modern financial technology everywhere. Who cares about yellow metal dug from the ground, you wonder naturally. Let me take you through monetary history to show critical patterns repeating, because what is happening today has happened before in different forms repeatedly. Those who ignore history are condemned to repeat the same costly mistakes. 1971. The Nixon shock changed everything. August 15th, 1971 changed the world's monetary system completely and forever. President Nixon appeared on television announcing the gold standard was finished entirely. Gold was trading at just $35 per ounce that day. Everyone thought gold was dead and irrelevant to the modern economy completely. Financial experts on television declared gold obsolete in the new fiat era. Economists claimed paper money backed by government promises was the future. They said gold bugs were living in the past, refusing progress. What happened next proved all the experts completely wrong about everything. Gold exploded from $35 to $850 by 1980. This represented a 2,400% gain in under 10 years. The so-called barbarous relic became the best performing asset of the decade. 1980. A Volcker's interest rate shock. Gold peaked at $850 as inflation destroyed American families. Paul Volcker became Federal Reserve Chairman and took drastic action to stop it. He raised interest rates all the way to 20%, incredibly high. People were paying 18% interest on mortgages to buy homes then. Credit card rates exceeded 20%, destroying middle-class household budgets across America. The economy plunged into deep recession, causing a massive unemployment and pain nationwide. But inflation was finally killed after years of rising prices everywhere. Gold corrected from $850 down to $250. This took several years, but the correction was brutal for gold holders. Does this mean gold was finished and the rally was over? History shows this was just a pause, not the end at all. 2000 to 2011, the Great Rally. Gold went from $250 to $1,900 in 11 years. Why did this sustained rally happen over such a long period? The dot-com bubble burst in 2000, destroying trillions in wealth overnight. September 11th, attacks in 2001 changed America and global politics forever dramatically. 2 expensive wars in Iraq and Afghanistan drained the U.S. Treasury. Then, the 2008 financial crisis nearly destroyed the global banking system. Lehman Brothers collapsed. Bear Stearns disappeared. AIG needed massive government bailouts to survive. Banks were failing. Governments printing trillions in emergency stimulus money desperately everywhere. Gold became the ultimate safe haven during this decade of chaos. It proved once again that in times of crisis, gold shines. 2020. The pandemic panic response. Gold hit $2,070 as COVID locked down the planet. Governments printed money on a scale never seen before in history. The Federal Reserve created $5 trillion in 18 months alone. Central banks coordinated the largest monetary expansion in human history rapidly together. Money supply exploded, asset prices surged. Inflation began brewing silently underneath everything. Gold responded exactly as it has throughout 5,000 years of history. When currency is debased, gold preserves purchasing power over time consistently. 2025 to 26. Right now, today, we are at 2,750 and momentum is building. Here is the pattern you absolutely must understand for your survival ahead. Every time monetary chaos erupts, currency debasement happens, geopolitical tension rises, gold surges. Every time faith in the financial system cracks, gold becomes the refuge. But here's what makes this time different from all previous cycles. Every past peak was followed by corrections and people declaring gold dead. Then it comes roaring back stronger, reaching new all-time highs eventually. Right now, we're not in a correction phase at all. We are in the early acceleration phase of what could become massive. This could be the biggest gold bull run in recorded human history. Historical performance never guarantees future results in any market condition whatsoever. Past market movements, while informative, should not be used as basis alone. Markets are unpredictable, and conditions change constantly without any warning to participants. Economic factors today may differ significantly from all historical periods mentioned previously. Always conduct independent research before risking your hard-earned money in anything. Let me break down 5 massive forces creating perfect storm right now. These forces are converging simultaneously, driving gold to levels few people expected. Understanding these will help you see what is really happening globally. Force 1. De-dollarization. Accelerating faster than expected. This is the biggest story that mainstream media refuses to cover honestly. The US dollar has been the world's reserve currency since 1944. The Bretton Woods system established dollar supremacy after World War II ended. For 82 years, international trade required US dollars for settlement. Oil priced in dollars, commodities in dollars, global reserves held in dollars. America benefited enormously from this exorbitant privilege for 8 decades consistently. That system is cracking, and the cracks are growing wider every month. The BRICS nations are actively working to end dollar dominance completely. Brazil, Russia, India, China, South Africa are leading this historic movement away. They are settling bilateral trades in local currencies, bypassing dollars entirely now, creating alternative payment systems like CIPS to avoid SWIFT network completely. And most importantly, they are buying massive quantities of physical gold bullion. Why is this de-dollarization movement happening now after 80 years of stability? In 2022, when Russia invaded Ukraine, Western nations froze Russian reserves immediately. Over $300 billion of Russia's foreign currency reserves were frozen. Think about that for one moment and let it sink deeply. Russia held $300 billion in supposedly safe Western assets and currencies. U.S. Treasury bonds, euros, pounds, sterling, held in Western financial institutions safely. With one political decision, those assets became completely inaccessible to Russia overnight. Every emerging market central bank witnessed that and thought one thing. If Western nations can freeze Russia's reserves, they can freeze ours too. You cannot freeze gold bars sitting in your own sovereign vault. You cannot sanction physical gold because it has no counterparty risk. Gold does not care about politics, sanctions, or international disputes whatsoever ever. China has been reducing U.S. Treasury holdings to lowest levels in years, down to $700 billion from over $1 trillion previously held before. At the same time, China bought gold for 18 consecutive months officially. This is not coincidence, this is deliberate strategic repositioning by largest economy. China understands something Western investors have not figured out yet completely today. This is not coincidence, this is deliberate strategic repositioning by largest economy. China understands something Western investors have not figured out yet completely today. Force 2. Inflation. Destroying real purchasing power daily. The Federal Reserve claims inflation is under control at target levels now. Official CPI data shows 3 to 4% annual inflation recently. But go to any grocery store and actually check prices on items. Check your rent payment or mortgage compared to 3 years ago. Look at insurance premiums for health, auto, home coverage that keep rising. Restaurant prices, haircuts, car repairs. Everything you buy costs more daily. Real inflation that you feel in your wallet is higher, significantly. Your purchasing power is being eroded every single day you wake up. The dollars you saved 3 years ago buy much less today. Gold has been money for 5,000 years across all civilizations continuously. It cannot be printed by central banks whenever they want more. It cannot be devalued by government policy decisions made overnight politically. Gold is the ultimate inflation hedge over long time periods, historically proven. When fiat currencies lose value, gold maintains and increases purchasing power consistently. Force. 3. Geopolitical chaos becoming the new normal worldwide. Look around the world at current events happening right this moment. Ukraine-Russia war continues with no peace agreement in sight. Middle East remains extremely tense with Iran-Israel dynamics escalating periodically. U.S.-China rivalry intensifies over trade, technology, Taiwan, and regional dominance. Taiwan's situation could explode into major conflict any time without warning. North Korea continues nuclear weapons development and provocative missile tests regularly. Global supply chains remain fragile after pandemic disruptions revealed weaknesses everywhere. Energy security concerns are rising as nations compete for resources globally. Uncertainty is the new normal in our interconnected world, unfortunately, today. When the world feels unstable and dangerous, capital flows to safety. Gold is that safety, the ultimate safe haven for thousands of years. No government can print more gold or devalue your gold holdings. Force 4. Banking system. Showing stress cracks underneath surface. Remember, Silicon Valley Bank collapsed in March 2023, shocking financial markets globally. First Republic Bank failed. Signature Bank failed. Credit Suisse needed rescue merger. That was not isolated incident affecting just a few poorly managed banks. Those were warning signs of deeper structural problems in the system. Regional banks still face pressure from commercial real estate loan exposures today. Office buildings are empty as remote work became permanent for many. Property values are declining, putting bank loan portfolios at risk of losses. The banking crisis is not over. It is just paused temporarily. When people lose faith in banks, they do not run to other banks for safety. They run to tangible assets they can hold and control themselves. Gold is the ultimate tangible asset with 5,000-year proven track record. Force 5, the debt bomb that cannot be diffused ever. $320 trillion in total global debt exists right now. $35 trillion in U.S. national debt alone and growing every second. The U.S. government now spends over $1 trillion annually just on interest. Let that sink in deeply for a serious moment of reflection here. $1 trillion every single year forever just to service existing debt. This does not reduce principal, just pays interest on debt already accumulated. This situation is mathematically unsustainable by any measure of economics or logic. Eventually, one of two things must happen to resolve this impossible problem. Default on the debt, which is politically impossible for major nations, or inflate away the debt by printing currency and devaluing money. Guess which option governments always choose throughout all of recorded history consistently. They print and inflate because it is politically easier than hard choices. When currencies devalue through monetary inflation, gold rises in price, mathematically guaranteed. This is not speculation. This is 5,000 years of proof. These are observable macroeconomic trends based on publicly available data and analysis. I'm not predicting specific outcomes or advising portfolio positioning decisions here. Economic conditions are extremely complex and subject to rapid change without warning. Always consult licensed financial professionals for personalized advice based on unique situation. These trends may play out differently than historical patterns suggest is possible. Now, I know what you're thinking at this exact point. What about Bitcoin and cryptocurrency as alternative to gold entirely today? Trump administration is crypto-friendly and Bitcoin just hit $90,000. Is not crypto the future, while gold is just old technology? Great question that deserves honest, thorough answer right now without bias here. Let me discuss this because the Bitcoin versus gold debate is fascinating. Both assets serve different purposes, and understanding the difference is critical for investors. Bitcoin's recent performance and volatility reality. Bitcoin is currently trading around $90,000 in January 2026. It has seen massive volatility over the past year with swings. Bitcoin dropped from 105,000 to 70,000, then back. These 30 to 40% swings happen regularly in crypto markets. Some investors love this volatility as opportunity for trading profits actively. Others find this volatility terrifying and impossible to sleep through comfortably. Bitcoin has existed for only 17 years since its 2009 launch. Gold has been money for 5,000 years across every civilization. Bitcoin requires electricity, internet access, and technology infrastructure to use or access. Gold works even if the entire power grid fails across regions. Bitcoin has regulatory uncertainty with governments still debating legal frameworks globally today. Gold is universally recognized and accepted by every nation on Earth. Can both assets coexist in portfolio strategies? Here's my honest take on this question many people ask. Both Bitcoin and gold can coexist in diversified portfolio strategy? Absolutely yes. Bitcoin represents speculation on technology adoption and future digital transformation over decades. Gold represents insurance against monetary system collapse and currency debasement over time. Bitcoin is for potential wealth multiplication if you can stomach volatility. Gold is for wealth preservation over long periods with much less stress. Bitcoin is digital native asset. Gold is physical tangible you hold. Bitcoin is new experiment. Gold is timeless and proven throughout human history. Both have legitimate roles, but they are not the same thing. You would not replace your home insurance with lottery tickets, obviously. Similarly, gold and Bitcoin serve very different purposes in portfolio construction today. Cryptocurrency markets are extremely volatile and speculative compared to traditional asset classes. You can lose your entire investment very quickly in crypto without warning. This comparison is educational only and not investment advice to purchase either. Always assess your personal risk tolerance before investing in volatile asset classes. Cryptocurrencies face significant regulatory risks that could impact values negatively and suddenly. Goldman Sachs raises target to $3,500. Goldman Sachs analysts raised their gold price target recently to impressive levels. They now predict $3,500 by end of 2027. This represents another 27% upside from current 2,700. Goldman cites continued central bank buying as primary driver of strength. They see geopolitical risks remaining elevated, supporting safe haven demand for gold. Their technical analysis shows gold breaking out of multi-year consolidation. The chart patterns suggest much higher prices ahead over next year's. JP Morgan sees sustained bull market. Continuing, JP Morgan's commodity research team is also very bullish on gold outlook. They forecast gold trading between 3,000 and 3,300. Central bank purchases showing no signs of slowing down at all. Inflation concerns and currency debasement fears support gold fundamentally, they argue. JP Morgan recommends clients maintain 5 to 10% allocation in gold. UBS highlights portfolio diversification, benefits of gold. UBS takes slightly more conservative but still very bullish stance overall. They forecast 2,900 to 3,200 range. UBS and emphasizes gold's role as portfolio diversifier during uncertain volatile times. Their research shows gold outperforming during high inflation periods. Historically and consistently, UBS recommends 5 to 10% portfolio allocation for protection and balance. What these predictions mean for average investor. Today, When the biggest banks in the world all agree gold goes higher significantly, that is noteworthy because they rarely all align on predictions simultaneously. These are not fringe gold bug websites making wild, unsubstantiated claims. These are serious institutions with billions on the line managing client money. They do not make forecasts lightly without extensive research and data analysis. Their track record is not perfect, but they employ massive research teams. If they are all saying gold goes higher, you should pay attention. Even if they are only 50% correct, gold has upside. Bank forecasts are not guarantees, and analysts can be completely wrong often. Predictions should not be relied upon as sole basis for decisions. Banks have potential conflicts of interest and may benefit from predictions made. Always conduct independent research beyond what any bank or analyst says. Past forecasting accuracy does not guarantee future prediction accuracy in any market. Let me be completely honest about risks, because everything involves risk always. I'm not here to just promote gold without discussing downsides. You need to know what could go wrong with this thesis. Every investment has potential problems, and gold is no different from anything. Risk 1. Federal Reserve raises. Rates dramatically higher. If Federal Reserve raises interest rates aggressively, gold could correct downward temporarily. Higher rates make bonds more attractive compared to non-yielding gold. This happened in early 1980s when Volcker killed inflation with rates. Gold dropped from 850 to 250 over years. Could this scenario repeat if inflation gets completely out of control? Yes, it is possible, though rates at 20% seem unlikely. Risk 2. US dollar strengthens. Unexpectedly against all currencies. If dollar strengthens significantly, gold typically falls in dollar price terms. This could happen if global crisis makes dollar least bad option. During extreme financial stress, sometimes dollar rallies despite long-term weakness. A strong, sustained dollar rally could pressure gold prices short-term. Risk 3. Central banks suddenly stop buying gold completely. If central banks stop buying gold, the primary demand driver disappears. This seems unlikely given current geopolitical tensions, but anything is possible. A coordinated central bank gold selling program would crash prices quickly. No signs of this happening, but it remains a theoretical risk to consider. Risk 4. Severe recession forces liquidation of all assets. During severe economic recessions, people sell everything, including gold, for cash. We saw this briefly in 2008 when gold initially dropped before rebounding. Short-term liquidation during panic can cause sharp temporary price declines. If economy crashes, people may need to sell gold to survive. Risk 5. Massive new gold discoveries increase supply dramatically. Large new gold discoveries could increase global supply over time significantly. While unlikely, massive finds have happened before in mining history occasionally. Increased supply without matching increased demand would lower prices over long term. Risk 6. Government confiscation. Like 1933 precedent. In 1933, President Roosevelt confiscated private gold holdings in the United States. Executive Order 61102 forced citizens to sell gold to government. Could this happen again if government gets desperate for assets? While unlikely, it is not impossible if conditions deteriorate badly enough. Bottom line on understanding risks before investing anything. Every single investment carries risks, and gold is absolutely no exception. You must understand these risks before committing any money to positions. Never invest more than you can afford to lose completely. Diversification across multiple different assets is always the smartest approach to managing risk. Risks mentioned here are not exhaustive, and other unforeseen risks exist. Market conditions change rapidly, creating new risks for all asset classes. Risk assessment should be done with professional help based on circumstances. No investment is without risk, including gold, which can lose significant value. We have reached minute 18, and I promised you revelation that changes. Here it is. So pay very close attention, because this truth matters. Are you ready for what nobody wants to tell you, honestly? The revelation? Fiat currency system is mathematically doomed. The current monetary system based on debt and fiat currency cannot survive. It is mathematically unsustainable because infinite debt growth is impossible on finite. Every single fiat currency in history has eventually failed going to zero. The Roman denarius collapsed, German paper mark became worthless, Zimbabwe dollar hyperinflated away. Venezuelan bolivar lost 99% of value in just years recently. The difference between these currencies is only timing a failure, essentially. Some take decades to fail, some take centuries, but all fail. The US dollar will eventually fail too. It is mathematical certainty. Maybe not next year, maybe not in 10 years or 20. But eventually the math catches up and currencies collapse under debt. 320 trillion in global debt cannot ever be repaid. The only way out is to print more currency and inflate. This devalues currency, making savers and wage earners poorer over time. Middle class gets destroyed slowly through monetary inflation they do not understand. Meanwhile, those who own hard assets like gold, real estate get richer. They own things that hold value when currency devalues through inflation. This is not conspiracy theory. This is exactly how system works. What this critical revelation means for your financial future. You have a choice to make right now at this moment. Continue holding paper currency that loses value every year by design, or own hard assets that maintain purchasing power over very long periods. Gold is not about getting rich quick in speculative bubbles at all. Gold is about preserving what you worked for over your lifetime. It is insurance against mathematical certainty of currency devaluation over decades ahead. The revelation is this simple truth. You are not investing in gold. You are protecting against your currency going down, which is guaranteed long term. Think carefully about that critical distinction because it changes everything about perspective. So what should you actually do with this information right now? Let me give practical guidance you can implement realistically starting today. Remember, I am not your financial advisor, so take this as education. Consult professionals before making any financial decisions with your hard-earned money. Do not take my word or anyone else's as absolute truth. Read books on monetary history and gold's role throughout different eras. Understand what happened in Weimar Germany when currency collapsed into hyperinflation. Study Zimbabwe and Venezuela to see modern currency collapse examples recently. Learn about the 1970s inflation and how gold performed then. Understand central banking and how money is created from nothing today. Knowledge is power and protects you from making emotional decisions under stress. Step 1. Educate yourself thoroughly before doing anything. Do not take my word or anyone else's as absolute truth. Read books on monetary history and gold's role throughout different eras. Understand what happened in Weimar Germany when currency collapsed into hyperinflation. Study Zimbabwe and Venezuela to see modern currency collapse examples recently. Learn about the 1970s inflation and how gold performed then. Understand central banking and how money is created from nothing today. Knowledge is power and protects you from making emotional decisions under stress. Step 2. Assess your unique personal financial situation. Honestly, how much debt do you currently have and at what interest? Do you have emergency fund covering 6 months of expenses saved? What is your personal risk tolerance for volatility in portfolio holdings regularly? What is your time horizon for needing this money back out? Are you young with decades ahead or older approaching retirement now? Your personal situation determines what makes sense for you specifically and uniquely. Step 3. Start small. If you're completely new, do not put entire life savings into gold tomorrow morning, impulsively ever. Start with 1 to 5% of portfolio if completely new. Get comfortable with how gold trades and volatility in markets over time. Learn about different ways to own gold before committing large capital amounts. Physical coins and bars, ETFs, mining stocks, all have different characteristics entirely. Each option has distinct pros and cons you need to understand first. Step 4. Decide between physical gold versus paper. Gold options. Physical gold you hold gives complete control without any counterparty risk. But you need secure storage and insurance for large amounts safely. Paper gold, like ETFs, is convenient and easy to trade quickly. But you do not actually own gold, you own paper claim. Mining stocks give leverage to gold price but company-specific risks. Each option serves different purposes in overall portfolio construction and strategy design. Step 5. Dollar cost average. Overextended time period. Do not try timing the market perfectly because nobody can do consistently. Dollar cost average by buying small amounts regularly over months and years. This smooths out volatility and removes emotion from decision-making process. Buy some when price is high, buy some when price is low. Over time, you achieve average price and reduce risk of bad timing. Step 6. Hold for long-term, not short-term trading. Gold is not trading vehicle for most people lacking experience and time. It is long-term insurance against currency debasement and system instability over decades. Hold through volatility and resist urge to sell during normal corrections. Corrections are normal and healthy in any sustained bull market over time. Stay focused on long-term thesis, not short-term price fluctuations. Step 7. Rebalance your portfolio periodically and systematically. If gold goes from 5% to 15% of portfolio, rebalance. Sell some gold and buy stocks or bonds to maintain targets. This forces you to sell high and buy low automatically consistently. Disciplined rebalancing is one of best strategies for long-term wealth building. Step 8. Stay informed but not obsessed with daily prices. Follow gold market developments, but do not obsess over daily movements. Check in monthly or quarterly, not hourly on your phone constantly. Obsessing leads to emotional decisions that hurt returns over long run. Final important thoughts on taking action wisely today. Gold is not get-rich-quick scheme or pure speculation. It is insurance policy against very real risks in monetary system. Every portfolio should have some exposure to gold, in my opinion, but the amount depends on your unique situation and risk tolerance. Never invest money you cannot afford to lose in any asset, and always consult licensed professionals before making major financial decisions with money. This entire video is for educational and entertainment purposes only explicitly. Nothing here constitutes financial advice, investment advice, or any recommendations to buy. I am not licensed financial advisor, broker, or investment professional at all. You should not make financial decisions based solely on this video ever. Always consult qualified licensed professionals before investing any money in anything. Past performance does not guarantee future results, and you can lose money. Gold can go down as well as up in value significantly. Markets are unpredictable and subject to many factors beyond anyone's complete control. I may or may not own gold myself and have personal biases. Do your own thorough research before making any financial decisions with money. This video may contain errors or outdated information despite best efforts. Neither I nor anyone else can predict the future of markets. Investing involves risk, including possible loss of principal invested in assets. Always assess your own risk tolerance and financial situation with help first. We have covered massive amount of information in these 20 minutes together. Gold hitting 2,750 is not random or coincidence. The market is telling you something extremely important about the future ahead. Central banks know something most retail investors have not figured out yet. They are preparing for massive changes in global monetary system coming. Whether you buy gold or not is your personal decision entirely, but you cannot say you were not warned about what is coming. The signs are everywhere if you open your eyes and actually look. Leave a comment below telling me what you think about all this. Do you own gold already, or are you considering it now? Hit that like button if you found this valuable and informative. Subscribe for more deep dives into finance and economics that matter. Share this with someone who needs to hear this message urgently today. Truth is out there, you just have to be willing to see. Thank you for watching, and I will see you in next video. Stay safe, stay informed, and protect your wealth wisely always, my friends.